All right. Hi, everyone. We're seeing many folks join, so we'll get started in just one more minute. All right. Thank you to everyone for joining us today for this year's Neighborhood Homes Coalition webinar, Unlocking Housing Supply and Home Ownership Through the Neighborhood Homes Investment Act. I'm Sarah Brundage, President and CEO of NOL, and I am very happy to be here with you today. Today's agenda, we're going to start with just a brief introduction on the Neighborhood Homes Coalition and some background on the legislation. We have a video to share with you from Senator Young, and then we will hear about how Neighborhood Homes Investment Act works with an overview of the legislation, followed by a terrific panel of housing and community development experts about the gap in financing for affordable single-family homes today and how the Neighborhood Homes Investment Act would fill that gap. And after that panel, we will talk through the advocacy landscape and how you can help support the enactment of this bipartisan bill. And there's time at the end for Q&A, but at any point, you can drop questions in the box at the bottom of your screen. So just as a brief introduction, the Neighborhood Homes Coalition is a national advocacy group of more than 50 organizations, including housing and community development nonprofits, financial institutions, and related trade associations, all coming together to support the enactment of the Neighborhood Homes Investment Act. And it is chaired by the National Association of Affordable Housing Lenders, the National Community Stabilization Trust, and LISC. And so you'll be hearing from myself, Sarah, and Matt, who we get to serve as the three co-chairs. And this is a list of the more than 50 national organizations that are members of this coalition. So why does neighborhood homes matter now? Why are you on this webinar? As I'm sure you know, since you're here, we are facing shrinking single-family supply and a narrow path to homeownership. New construction is not keeping up with demand, especially within affordable price ranges, and many existing homes are aging and require substantial repairs to be livable and safe. The median age of a home in the United States is a record 44 years now, and many lower-income homeowners can't afford to finance critically needed repairs. At the same time, mortgage rates are elevated and home prices remain high due to low supply, pushing monthly payments out of reach for many families. And the median age of today's first-time buyer is also at an all-time high of 40 years old. And income-based gaps in homeownership persist and in some cases are widening. So why neighborhood homes? Why now? There is no market solution for what these neighborhoods need. Building and repairing vacant homes and aging housing stock, especially in disinvested areas, just doesn't pencil out without additional help. And builders and developers often can't close the financing gap for rehab or new construction in distressed communities. Neighborhood Homes directly targets this challenge by unlocking capital to rebuild and restore homeownership in places that the market has left behind. This credit provides the missing tool to bring additional private capital into communities where home ownership demand exists, but financing gaps stall progress. And this is a scalable solution that can revitalize neighborhoods, expand ownership opportunities, and stabilize housing for the long term. So next, we're going to hear what Congress is doing about this. Senator Young has represented Indiana in the U.S. Senate since 2017 and is one of our congressional champions of this bipartisan bill, leading with the introduction of the Neighborhood Homes Investment Act alongside Senator Warner.
Hello, I'm Senator Todd Young. It's great to join you today and have this opportunity to share a few thoughts on my Neighborhood Homes Investment Act. I reintroduced this bill last year alongside Senator Mark Warner of Virginia to help revitalize housing in distressed communities nationwide. In today's housing market, the cost to build or renovate a home is often greater than what the home is actually worth once completed. There are tens of thousands of vacant and abandoned homes sitting in neighborhoods where renovation simply doesn't pencil out, leaving blight and lost opportunity. Our legislation is designed to fix this. The NHIA creates a targeted federal tax credit to bridge the value gap, but only after a home is finished and sold to a qualifying homeowner. In other words, the investor takes on the risk, not the taxpayer, and the incentive is directly tied to successful revitalization. The bill also includes strong affordability protections. Homes must be sold to buyers earning less than 140% of the area median income, and only communities with high poverty and low property values qualify. In addition, state housing agencies will allocate these credits through a competitive process with annual caps to ensure the program remains efficient and targeted. This isn't a one-size-fits-all program. States and localities will target resources to the communities that need them most. This is a thoughtful, accountable investment that can strengthen neighborhoods, support current homeowners, and increase access to affordable housing, all without displacing the communities it's meant to help. Now, it's about making sure that existing residents can benefit from economic investment, not be pushed out or harmed by it. There's growing recognition in Congress that we need targeted, market-based solutions like this to address the affordable housing crisis. So I encourage all of you, advocates, community leaders, and engaged citizens, to join us in urging my colleagues in Congress to pass this bill. Together, we can help restore neighborhoods and ensure more families have access to safe, stable, and affordable housing.
Again, we thank Senator Young and Senator Warner for their leadership on this critical bipartisan legislation. With that, I'm going to now turn it to one of my co-chairs, Matt Josephs, who's going to give an overview of the legislation and how it will work. Matt is the Senior Vice President of Policy at the Local Initiative Support Corporation, or LISC. And prior to joining LISC, Matt worked for 13 years at Treasury CDFI Fund. So turning it over to you, Matt.
Okay, thanks, Sarah. Let's go ahead to the next slide. We definitely want to walk you through the legislation. That's our goal here, so you have a little bit of better understanding of what we are trying to accomplish here and why we think this will be such a successful initiative. So as Senator Young mentioned, he is the lead along with Senator Warner on this Senate version of the legislation, which is S-1686. And we are currently up to the 10 bipartisan members of the Senate that have now co-sponsored the bill. On the House side, the bill numbers HR 2854. They are identical pieces of legislation, and we're now up to 65 bipartisan co-sponsors across 24 different states. Now we are, last year, the House version had over 100 co-sponsors, and we certainly hope to get there before the end of this session again. So what is it? It's a state-administered credit. So for those familiar with the low-income housing tax credit, it's kind of a similar kind of allocation structure where each state gets a per capita formula allocation of these federal credits, with the requirement that every state get at least $12 million of credit allocation authority. Otherwise, it's $9 per capita. And so it's about $3 billion that'll be allocated nationally each year. And the governors, the state will decide who to administer it. We imagine it will be housing finance agencies, as with the low-income housing tax credit. So what the states do is they write what are known as qualified allocation plans to solicit proposals. So they will put out there a certain amount of their credits that are available in any given year and invite developers to submit proposals. And there are statutorily required criteria that the states must consider, and that is the neighborhood need, what is going to be the overall impact on stability, revitalization, what is the track record, what's the capacity of the applicant or project sponsor, will this lead toward long-term home ownership is one of the key issues, and then obviously anything else the state would like to add to its selection criteria. The states are also responsible for compliance and monitoring these organizations to make sure they deliver on their projects, and that can include inspections, or at least putting the inspection protocols in place, setting up the standards for construction, the costs, the quality, and most importantly, developer fees, because the developer is part of this. The developer will be getting compensated. It's really up to the states to make sure they put the appropriate guardrails on developer and other fees. Um, so they will make they'll review these applications, and they may come from developers or investors or even lenders could apply for the credits. So the state will make the selections, and then once selected, the awardee has 5 years to raise the equity capital from the investors and to start building and rehabbing homes. And as the senator pointed out in his remarks, you cannot claim the credit until the home is actually built and sold to an eligible homeowner. So it's very much almost like a pay for success kind of initiative where the federal dollars are not put into the project until it's done. It does target community. It doesn't have to be exclusively in lower income distressed communities, but it definitely targets those communities. So all state agencies are required to ensure that not less than 60% of the allocations are invested in what we're going to call distressed census tracts. And those are characterized by high poverty, 30% higher than the area poverty rates, low median family incomes, so that's at or below 80% of the area, and low home values in census tracts where the home values are below median. So it's got to meet all three of the criteria, and 60% of the allocations must go to those communities. There is some additional flexibility, though. States can provide up to 20% of the allocations in other designated census tracts, which include low-income rural communities, which might not meet the other criteria. It can be communities that are impacted by natural disaster that doesn't meet the distress criteria, and in certain home rehabs for gentrifying communities, so that the families can afford to stay in those communities and make repairs to their homes. And then up to 20% can really be used anywhere that the Housing Finance Agency wants to use it, provided that they have provided a explanation or justification in their qualified allocation plans. And if you're one of the small states I mentioned that are getting the minimum allocation of 12 million, there's additional flexibility that up to 40% of the credits can be used in either of those two categories. Right there, up to 20% can be up to 40% in either of those two categories. Next slide. So what kind of homes are we talking about? Really any kind of single family home you can think about. So it's manufactured or stick built, it's owner occupied, with 1 to 4 units, it's condos, it's cooperative housing. And it can be new construction, it can be substantial rehab that you're going to bring to the market for sale, like a vacant home, vacant lot. And it's, again, for owner-occupied rehabilitations as well. So it kind of gets both the new development of homes and repairing homes with homeowners already in them. So what are the eligible borrowers? It is for families generally making up to 140% of the area median income. But if a state wants to take advantage of that flexibility to go outside of the economic identified communities, then they would have to target lower income homeowners in those communities. So in some instances, it's going to be capped at 120% of AMI. The maximum for new sales, the maximum home price cannot exceed 4 times the area median family income. So in this example, I'm using roughly the national median family income, which is 84,000. So in a market where you're looking at that kind of income dynamic, the maximum homeowner income would be 117,000, which is 140% of that 84,000, and the maximum home price would be 336,000, which is 4 times the area median family income. And that's all usually used as a statistic for affordability, is 4 times a family income for a home purchase price. And of course, now with the prices rising, it's become closer to over five times that amount. So this is something we're trying to really tackle here. If you're doing an owner-occupied rehabilitation, then the homeowner must be below median income in the area. Okay. So how's the credit work? What are the limitations? I mentioned that the credit's applied for by developers, uh, but there are some caps on how much credit can be claimed on any given investments in properties. And what the cap is, it's really you look at three different variables. One is it can be up to 40% of your total development costs. So that's your acquisition, your development, your demolition, construction, et cetera. Up to 40% of those costs are potentially eligible. But there's a national cap, and it's at 30% of the national median sales price of homes. In 2024, that was about 420,000. So it was been roughly 134,000 would be the maximum cap you can use. So right now we're saying it's either 40% of your total development costs up to 134,000. But and this is what we really think is the most unique and one of the most important aspects of the program. It cannot exceed the actual gap between your total development costs and your final sales price. So there's a real built-in mechanism to make sure there's no windfalls here because, and that's another benefit of the credit not being claimed till after the home is sold to an eligible homeowner is that you actually have this information. You know what the development costs were, and you know what the sales price was. So that is the limit. Even if you're eligible for more for your development costs, you still cannot exceed that gap. So that's how we know we're making this whole and that there's not a lot of windfall gains on this. For an owner-occupied rehabilitation, the credit's actually worth 50% of the investment. Thank you. Yeah, 50% of the investment, but only up to a $50,000 maximum cap. So that means you could theoretically put $100,000 of development of rehabilitation costs into a home, and the investor can claim a $50,000 credit. And that this mechanism for the owner-occupied rehab is really to help out with homeowners that really cannot get conventional debt because their home might be underwater, or maybe they're older citizens and they don't have as much income flow coming in to pay off a typical loans. Okay, so I want to just run through these scenarios again very quickly about how this credit can be used and how it really can address a number of issues our communities are seeing. The first one is this traditional value gap, where just costs with rising construction costs in certain communities with lower home values, it just doesn't pencil out, and that's the words the senator used. So this might be a rural community, or it might be an urban community, where he would say Gary, Indiana, where you just have maybe more vacant homes and lots, and the home prices just don't support the amount of construction it would take to bring them to market. So let's, again, using that example of it, we're looking at one of these types of communities, the area median income's at that $84,000 level. Again, you could sell a home to somebody making up to 117,000. The sales price cannot exceed 336,000. And let's say in the market, we're going to talk about the market rate home is about 250,000. So again, for those, especially in higher cost market, that's a really low price, but in other markets, that's what we're looking at now. And we just cannot build that home for that price. So let's look at the next slide. So like in a market like that, it might be relatively inexpensive in the grand scheme of things to do the land acquisition, but your construction costs are really high with rising costs of labor, materials, et cetera, insurance, climbing costs. So now you're looking at $300,000 of total development costs. Again, you're trying to sell the home relative at a market rate of 250,000. So that leaves you with a $50,000 gap at the end of the day. Then you look at, well, what are the three criteria again for how much credit I can claim? Well, 32% of the national home sales price, 134,000 is one. The 40% of the 300,000, that's 40% of your development cost is the other. But again, you can only claim it for that actual gap. So this developer would be able to use a $50,000 credit for this project, and now they could go on to do additional homes with their credit allocations. And that's the incentive for investors. So one of the questions we get is, well, won't investors or developers be incentivized to just put as much subsidy into the home as possible? No, because they want to build as many homes as possible. So they're going to want to stretch the credit as far as they can. Okay, so scenario two is what I want to talk about, both this value gap, which we're seeing pretty much in most markets, but also an affordability gap. In markets where the housing tends to be hotter, lower income families, first time home buyers are really having trouble getting a foothold into that market. And I think the average age now of a first time home buyer is over 40 for the first time ever. So you know the kind of issues we're trying to deal with getting the home buyers into the marketplace. So say we're in a little bit of a hotter market. The area median income's higher. It's 100,000 in this example. That means the eligible home buyer it can be up to 140,000 of AMI in these markets. And the sales price can be higher too. It's 4 times that $100,000 amount. So now you can sell the home for $400,000 in the neighborhood homes. And let's say that's what the market rate price is. It's going to be $400,000 is what the market is, kind of the typical home is. Okay, so in this scenario, I bumped up the land acquisition significantly because in these hotter markets, the land is just much more expensive. Even the construction cost might be a little more expensive, but we'll keep it roughly the same. And that brings the total development cost to 410,000. So in this scenario, the developer would be able to claim a credit if they wanted to sell the home at 400,000. They could claim a $10,000 credit for their excess expenditures that it took to bring this home to market. But suppose they want to sell it at a lower price. Maybe they want to make it available to somebody at 90% of the area median income for kind of a lower income home buyer program, which is desperately needed in the hotter markets. They could actually lower the price of the home and count that towards the gap. So they might have a $360,000 sales price. And that the gap here is again 50,000 that they can now claim. Essentially, 10,000 would be your value gap. 40,000 would be this kind of home buyer gap to get a first-time home buyer into that home. Now, I should caution that this is not the model you'd want to use repeatedly and throughout because there's a risk when you start lowering the home prices that you're going to mess with the appraisals in the general community. So you want to do these, I think, judiciously if you're a housing finance agency, but this is a possibility. And we actually, when we get to a later part of the presentation, we're going to talk about some of the tweaks we are going to see in the next version of the legislation that actually addresses this very issue. Okay, the last scenario I mentioned was owner-occupied rehabilitations. So again, that's a 50% credit for 50% of your costs that aren't otherwise reimbursed. So the developer can put in $60,000 in this example. The investor is going to get the tax credits on that. That covers about $30,000. So now you could kind of provide a product to the borrower where they're going to get essentially home equity for $30,000 and then about $30,000 of additional to cover the development costs. So that's the big advantage to those programs. And I think we'll hear a little more about that later too. Okay, so claiming the credits, again, only after the project is placed in service. It's owned by an eligible homeowner. They're claimed by the investors on a rolling basis throughout that 5-year period. They don't have to wait till the end of the 5 years. They can claim the credits as in every tax year the homes are sold and come to market. So there's not really a lengthy time period for claiming the credits, and there's not a lengthy compliance period where investors will be subject to recapture. So I think this will be very attractive to investors. There is a bit of a penalty to the homeowner because we want them to stay in the communities, not to flip the houses. They're expected to stay for at least 5 years. And if they sell their home sooner, they would have to pay a penalty on any of their gains back to the housing finance agency. So what are the impacts we project? We think that over 10 years, we'd be building over 500,000 homes, over 150 billion in development activity, over 1 million new jobs, lots of local tax revenues generated by putting homes into productive use and repopulating the communities, getting rid of the blight and vacancies, and of course the home ownership opportunities for first-time home buyers. So really it really checks off a lot of boxes. And with that, I think I'm turning it over to the next panel.
Really quick, Matt,
Yeah.
we did have some questions that we've been answering, but one of them was, before we move on, since it's very much about the proposal, does the construction cost number you presented assume prevailing wage?
I would say don't does the legislation itself presume that, I guess is the question. The numbers we put together were kind of back of the envelopes. So I wouldn't dig too deep into those. It wasn't based on a specific market
An
analysis.
illustrative
Yes,
example.
it was just kind of illustrative.
And Matt, I
But I
will
do
say
think,
that
yeah, go
federal
ahead, Dirk.
credits in and of themselves don't necessarily trigger prevailing wage. If there's some type of financing or other subsidy that comes in, maybe, but the credit itself will not trigger that.
Great point.
Great. And several folks asked, we will send out these slides to attendees afterwards. So you can continue to ask questions in the Q&A box, but now we are going to turn to a practitioners panel that my other co-chair, Sarah, will be moderating. And the panelists include Alex Cabral, who's the Senior Principal of Innovative Finance at Grounded Solutions Network, a national nonprofit membership organization committed to increasing the supply of affordable homes. Deborah Flannery, or Deb, is the Deputy Executive Director of the Vermont Housing Finance Agency. And Kevin Nowak, from President and CEO of CHN Housing Partners, a large-scale affordable housing developer, housing service provider, residential lender, and housing intermediary, working with its partners in Ohio, Michigan, and Pennsylvania. And Dirk Wallace from Novogradac, which is a leading national professional services organization that works extensively in affordable housing and community development tax in particular. So turning it over to you, Sarah.
Great. Thank you. And thanks everybody for being with us today. Um, let's just jump right in. I would love if you could each tell us a little bit about your organizations and what are the primary barriers you're facing to creating more for sale housing in your markets, and how can the Neighborhood Homes Investment Act help? Let's start with you, Kevin.
Sure. Glad to be here. Thank you. Thank you for the opportunity. Mr. Kevin Nowak, President CEO of CHN Housing Partners, as well as our nonprofit mortgage company, CDFI Believe Mortgage. When we look across our markets, we are based here in Cleveland, Ohio, founded in 1981, really focused on home ownership and housing stability across the board. We also have offices in Detroit and Pittsburgh, and are working in the homeownership space in Cleveland and Detroit in particular. When we look at trying to deliver new or rehab units, the Neighborhood Homes Investment Act really helps us to get over the finish line. When we're looking at things like the cost to build new homes, when we're looking at the availability of affordable quality inventory, we're looking at the need to be able to deliver high quality, affordable starter homes. When we look, the construction costs, the availability of the units are really fundamental barriers for our markets.
Great. Thank you. Alex, let's go to you next.
Thank you, Sarah. Good morning, good afternoon, everyone. My name is Alex Cabral. I'm at Grounded Solutions Network. We're a national nonprofit focused on housing with lasting affordability. And when I use that term, housing with lasting affordability, I'm referring to housing models like community land trusts, limited equity housing cooperatives, deed restricted housing. These are housing models with a legal document that requires affordability for oftentimes more than 40 years and a resale formula that keeps units affordable in perpetuity. We support the sector fairly comprehensively through federal policy advocacy, sector research, and technical assistance for housing organizations, policymakers, and funders. So, talking about this question about barriers to expanding for sale housing, I'm here on behalf of our membership. We have over 300 members across the US, most of whom are housing organizations. They're your local CDC, they're your local Habitat affiliate or community land trust. We know there's so much demand for affordable housing in the US. And we've talked to members that have home buyer pipelines that are in the hundreds, yet their annual housing production is often in the tens. And this is often because, as helpful as it is, nearly every home and every affordable home in the US requires some type of subsidy. It's often public subsidy from local, state, federal government. And the subsidy is often limited, competitive, bureaucratic. It can take years to get a single project off the ground. And that's why neighborhood homes could be so transformative for our sector in particular. Not only would it improve the availability of subsidy, but also the timing of production would speed up dramatically. And I'm also here representing my organization, Grounded Solutions Network. We actually entered into the real estate space acquisition of real estate fairly recently, and in large part to solve this challenge of limited subsidy available to our members. How can we help them scale their housing portfolios? So we created Homes for the Future. It's an impact investment fund that acquires single-family rental portfolios, typically institutionally owned, and converts them into home ownership opportunities with lasting affordability. And we do this with no public subsidy needed. But it's only possible because rather than relying on public subsidy to create affordability, we use time. Our model takes about 7 to 10 years. And so this is still a very long time horizon given the urgent need of housing. And neighborhood homes would help our efforts as well, with our fund in many ways. We could use these funds in our model because we require funds to do AC rehabs. It would make our model viable in geographies where it currently doesn't pencil. And it would dramatically reduce our timeline from that 7 to 10 year mark to well below the 5 years. So I'm here on behalf of our members and our organization, and I'm happy to have this conversation.
That's great. Thank you so much for being here. Dirk, you sit in a different part of the ecosystem, but no less important. Can you share a little bit about Novogradac and how you see the space and what neighborhood homes could add?
Sure. Dirk Wallace, I'm a partner with Novogradac. Many of us might know us from, new market tax credits, low-income housing tax credits, renewable tax credits, any tax credit that's out there. So it kind of made sense to kind of start looking at, the neighborhood homes tax credit. We've been getting a lot of feedback from our developer community and investor community and syndicator community, where everyone kind of really wants to hit the ground running with this. So we've been, creating models kind of behind the scenes, looking at how, these might be structured, how allocations might be made, and really just kind of looking at this and saying, when this gets passed, we really need to hit the ground running with this. So we've been very involved with pretty much the industry participants of, low-income housing tax credits and other tax credits, just to see, really how could we get this to, be structured and just, get the deals done. So that's pretty much been our involvement kind of to date, and kind of looking at the legislation and seeing how this would work for our investors and our developers.
Thank you. That's actually a great transition to Deb. Deb, in Vermont, you just over the past couple of years, you rolled out the middle income homeownership development program, which has some similarities to neighborhood homes. It complements an existing homeownership tax program you all have been operating for some time. Tell us a little bit about the program and, any lessons learned, milestones so far that you'd like to share.
Yeah, thank you. The Middle Income Homeownership Development Program, a big mouthful, was created by the Vermont legislature in 2023, and it provided at the time, I think it was in two different allocations, about $24 million, with 15 million of that coming from ARPA allocation, and then another 9 was state general fund appropriation. And the goal of the program was to spur new housing production to meet the demand that has been, like in most places, woefully underserved. It is important to note that even though these funds were awarded to VHFA to administer, in 2023 we had a period of time where the applications came in, and then the planning for the projects has happened, and assembly of other resources as needed has occurred. And where we have only in the last year actually been dispersing funds. So about a year ago, our disbursements ramped up significantly, thankfully, so that we could meet the ARPA deadline, which our state imposed on us of March 31st. So we just completed the first deployment of that $15 million of ARPA money. So we are not fully through our entire allocation of 24 million, but in this time frame have learned a lot about what's working and what needs maybe some tweaking over time. We have the combination of factors that are affecting so many regions and states. In Vermont, we have just an acute shortage of supply, high costs of construction, and just an insufficient pace of development to meet demand. And this program is designed to create developer incentives to expand home construction to address that lack of supply. It comes to us not as a tax credit, but as you noted, we do have a 15-year-old homeownership development tax credit. So I know a lot of states have home buyer tax credits that they use to fund down payment assistance. We also have that, but this is a particular one that we've been operating for 15 years now, that is a nice companion to this middle income program. And so it gives us in total about a $3 million of additional funds to use and deploy, in addition to the 24 million that we have for middle income every year. The middle income program has a lot of similarities with this initiative, and it includes a cap of 35% of TDC as the amount of funds. Although it's not a tax credit, it comes in as a grant. So that's a bit of a difference. We do layer it with our tax credit as well, but the state homeownership tax credit program is limited to primarily, it's not completely restricted, but it primarily is used to support our significant shared equity program network through the state, and so that we are achieving with those funds generally a perpetual affordability, as opposed to that's not a requirement of the middle income homeownership development program. But within the middle income development program, we have 30% of the funds are set aside for our shared equity. So we have a combination with up to 70% of it being available to for-profit private developers for market rate development. The income limits are quite generous. It started out, the legislature authorized it to go up to 120% of area median income. And they subsequently increased it to 150% of area median income. And in Vermont, that represents, 97, something in the order of 97% of the population. So it's really meant to be a program for all, to support all Vermonters in a sense. And that translates to about somewhere between, depending on the region, because of course our area median incomes vary by market area, and it's between 170,000 a year up to 195,000 a year in some places. So it's truly a middle income program. I would just say also, though, despite the limits that we have, and we can go up to about 70% of the households served are at or below 100% of the area median, and then only a handful are between 120 and 150. So we still are really generally seeing that these programs are serving more of that moderate income target. Some things that we've learned are the program that we've launched includes both appraisal gap subsidy, so we call it developer subsidy, so that developers aren't having to manage the risks of costs being more than the home appraises at. And also affordability gap, so that when they complete the home, they'll know they have a eligible market that can afford the home. So the program allows for both. It was initially awarded to the developers to sort of make that have a flexible way of applying those funds as they would be needed in the project. And historically, with our state tax credit, it was only limited to affordability gap, so it wasn't used for value gap. So it wasn't as effective a tool at actually spurring and accelerating the pace of development. It was really just about creating the affordability piece for the home buyer on the back end. We found that value gap, appraisal gap component has really supercharged our ability to reach new markets and incentivize development that wouldn't otherwise be occurring. But it can be tricky in working with private developers and allowing them to assign affordability gap. They're not really skilled in understanding income limits and how to calculate those things. Not really. They aren't licensed lenders, so we need to figure out a better path in order to, and we are sort of backtracking on that and trying to figure out how to create participation by lenders to do that piece for this program. So that was just a piece that we learned and that I think we would set up and be more proactive around in the future iteration. The other thing I will say about having tax credit, even at the state level, just the state tax credit program, is that in working with the developers that we typically see, many of them are not accustomed to going out and marketing tax credits. If it's a habitat or it's a smaller scale developer, or even just a developer in a smaller community that's local. And so what we've done at VHFA is undertaken that as our role. So we actually sell all the tax credits to the state banks, mostly, or other investors. We then just monetize that and make it in the form of a grant to the developer. So it saves them that piece. And so I don't know if that would have relevance for how we think about a federal credit in that vein. That's all I
That's
have.
great. No, thank you so much. And thank you for, I mean, it's, that's a pretty quick turn to get a program, passed by the legislature and get money out on the street. So congratulations on all of that. Real quick, I know that the Middle Income Homeownership Development Program was funded primarily through ARPA. How would neighborhood homes kind of help with the next chapter of this work were it to pass?
Well, it is a one-time allocation. And so as I said, I think I alluded to, we've learned a fair amount from this effort. And it would be a real shame to see it just stop and not continue. We see a lot of demand and a lot of need for this kind of thing. What we've done, it gives us the ability to test different models of development. Cost is a huge issue for us. And developers are going to struggle to find the best path to create housing in different contexts around the state, in particular in our rural regions. And so I think we see that by being able to cover and close these appraisal gaps, and we have a project now that's testing an offsite construction modular design, and they're creating 50 homes in a market where it's a very small town of Middlebury, Vermont, home to Middlebury College. And this community has only seen about 10 homes to 15 homes built in the past 10 years. So they don't have a tested, proven market for new development. And this project is very ambitious. It's expecting to bring about 50 new homes to the community. It's in partnership with Middlebury College, so they have the support of an anchor institution in the community. And we really would love to see that replicated elsewhere around the state because we know that we have some unproven demand, and it's going to be very hard for the private sector to just jump into these things and without the support and the backing of our public subsidies grow this effort. And so we just would love to be able to continue the work and not have lost all the benefit of learning through this initial deployment.
Thank you. Kevin, pivoting to you, one of the less well understood parts of the Neighborhood Investment Act, but I think one of the most exciting, and I think there's a few others who agree, is the way that you could use these tax credits to help homeowners fix up their current homes.
Sure.
CHN was a real thought partner as this part of legislation was built out. So I was hoping you could share a little bit about why repair matters when we're talking about supply and how CHN would use the Neighborhood Homes Investment Act credits to address some of the supply challenges in Cleveland.
Sure. Yeah, happy to cover it. So when we think about homeownership, a lot of times people think about the homeownership kind of getting into homeownership, right? When we're thinking about homeownership, we're thinking about people becoming a homeowner, but then also people realizing the full value of homeownership, right? So when we look in our communities, you look in Cleveland, you look in Detroit. In Cleveland, we have a study that's done regularly that looks at asset quality. And it grades homes from A through F, right? So A being the best, F being having the kind of the most capital needs. Just those homes that are graded D or F, if you were to put $30,000 into each of those homes, it'd be a $1 billion need. Okay. In Detroit, University of Michigan Poverty Solutions, go blue, had estimated there's a $2 to $4 billion capital need for home repair in Detroit. When the city of Detroit put out home repair, as part of ARPA, and then there's and there was other private funding, there was essentially a run on the bank. Tens of thousands of people who tried to approach, to be able to get those resources. So there is a incredible capital need within our communities that isn't just in the big cities like a Cleveland or Detroit, but even into some of the cities like in Elyria, Ohio, where there's significant capital need that we're looking at capitalizing a kind of a preferred home repair fund. When we look at our mortgage platform, Believe Mortgage, which is a residential mortgage CDFI, 25% of all our contracts that fell, last year fell out because of a critical home repair need identified in an inspection, right? And it was at least one contract for each of our borrowers that fell out. We had one person that took 5 tries in order to become a homeowner because of critical home repair needs that were found within the homes they were trying to buy, right? So, when we start adding up those facts, what they show, one, is a barrier to homeownership. to a barrier to people realizing the full value of homeownership. And we begin to see a supply constraint, right? Because a lot of there may be homes available, but they're not quality homes, they're not affordable homes, and we need to do more to improve them. We have for years focused on the fact that that home repair is about housing stability, but not just about housing stability. It is about home ownership, right? Because when you have a home that has been maintained and it is inherited by, or somebody you try to sell that home, is more likely to get kind of full value and also not to fall into investor hands. An example I'll give is out of Detroit. My old neighbors across the street from me, from where I grew up. When my neighbor passed away recently, he had kept up he did not have significant deferred capital needs in his home, right? So he is able to demand full market for this home, right? However, his family is able to demand full market for the home. But when he had when he passed away, people found his name in the obituaries, found his family's names, found their phone numbers, and approached them with a extremely low cash offer for the home, right? So if we are not maintaining our homes, right, and if part of Neighborhood Homes Investment Act is about neighborhood stability, we can't just look at the new offering, but also at those kind of owner occupants. So when we think about home repair and kind of how this addresses, there's really four things that this is addressing. One, it's the cost of the capital outlay, right? And as we mentioned, this is up to 100% of the area median income. So we're talking about low to kind of middle income play here, right? We're talking about teachers, we're talking about police and fire, we're talking about a lot of people who could take advantage of this opportunity. The cost of the ability to finance, so when we look at how much it costs right now to get a home repair loan, that is prohibitive with where interest rates are. We look at challenges in home values themselves, and we look at challenges in the availability of capital, period, right? Particularly in neighborhoods that may see the most capital needs. So once we do this, repair, whether it be, in the primary through the Neighborhood Homes Investment Act, you are seeing a fuller approach to supporting a neighborhood, right? We've stabilized that homeowner, right? We have shown investment in the neighborhood. Permits are pooled. People are seeing that roof improved. You're seeing other people beginning to also improve their homes, right? And you're starting to get, aside from the transactions, right, that are necessary in neighborhoods to stabilize and improve values, also people seeing permits pooled within those neighborhoods sees that activity and also helps to stabilize and improve values as well.
Thank you for tying this to the neighborhood stability and the stability of existing homeowners. I think that is absolutely a core part of Neighborhood Homes Investment Act. So we are running a little bit short on time. So we're gonna finish out our questions, but a little bit of a more lightning round approach. So Alex, tell us a little bit more about how you see a tax credit program like this expanding your reach, particularly in markets like rural markets where your current approach isn't penciling.
Yeah. If I could ask y'all to share the slides of the map, I'm going to show y'all a map of community land trusts and shared equity entities in the US. And just a quick note, if you are a shared equity entity and you're not represented on the map, email me and we'll get you on here. The blue areas represent the areas that are served by a shared equity organization, kind of their self-stated jurisdiction, so to speak. And the orange dots are the location of these shared equity organizations, their city headquarters. So the map isn't saying that there are no affordable housing developers in these areas. It's saying that the areas that aren't covered in blue don't have a shared equity or lasting affordability option. So that's one less housing type available to families, one less stepping stone to traditional homeownership. And you can see that entities have overlapping service areas is often due to new entities forming to meet specific community needs or high demand. And we can see some trends. There's a lot more coastal coverage. The entities operating in the middle America often don't cover an entire state. Their service area might just be a city or a town, which suggests there are limited resources that aren't allowing them to expand. And you can see a lot of areas on this map don't have coverage at all. So neighborhood homes could especially help fill these gaps where subsidy is oftentimes scarce, so much so that affordable housing organizations sometimes have a disincentive to launch there or launch but fail to remain in operation because development can be so challenging. So I'll provide a specific example here if y'all can move to the next slide. I spoke to one of our members, Chaffee Housing Trust. They're located in Buena Vista, Colorado. They serve Chaffee and Lake counties. That's just under 30,000 people. And their service area, as you can see from the black and red circles side by side, is just over 2 hours outside of Denver. So it's not considered Denver metro. It's rural. It's surrounded by public lands. There's ranching activity. It's very mountainous. Um, and so where the city of Denver is located on the map, you might be able to see there's a cluster of shared equity entities there. And Chaffee's service area actually overlaps with one of the Denver-based community land trusts, Elevation CLT. But there's a difference here between Chaffee Housing Trust's location and those of its peers just 2 hours away. And that's availability of public subsidy. So most urban areas benefit from a mix of local, regional, and state public sources. Chaffee Housing Trust only has access to state housing subsidies in the area in which they serve. And here's the thing, the Chaffee and Lake counties are beautiful places to live. I talked to their executive director this week, and they told me people come to play, but pay to stay. So in recent years, there's a growing influx of high wealth, high income earners moving to the area. This has caused home prices to increase to the point where the local workforce can no longer afford to live there and find housing, and the multi-generational families who have lived there have needed to move away. So the median home price, for example, in this region where Chaffee Housing operates is $850,000. And Chaffee Housing Trust sells their homes at $250,000. So Chaffee's often the only option for many local folks. And they currently have access to $120,000 in state subsidy per unit. But to get the price down to this $250 limit, they often need $175,000 in subsidy per unit. So there's this $50,000 gap. And we did not coordinate on this previously. That's just what the ED told me. There's this $50,000 gap for every unit that they must creatively bridge in order to build, and it can be really challenging. So I think this is a great example of a case where, neighborhood homes can make a huge difference in a local rural market.
Alex, thanks so much for bringing us just the flavor of the various kinds of markets. Shared equity homeownership works in, as well as a tax credit program like this. We are short on time, so Dork, we're going to close out with you to talk a little bit about if you can share a little bit about how neighborhood homes would work for investors. And, Novogradac has been involved in all of the major tax credit programs. These can be hard to get off the ground. What are some of the lessons learned that we should keep in mind when we get to an implementation period?
Yeah, so I think as Matt said, I mean this is a $3 billion allocation. So I think we're going to see institutional investors. I think when you kind of look at how the LIHTC is structured, I think a lot of us are familiar with that. I think we are going to see kind of that fund kind of similar structure where you have investors investing into a fund goes out and finds properties generate the credits, and kind of everything flows up to the fund. I think when kind of looking at really the timing of the credit and the risk of recapture, I think those are going to be kind of the two main things that investors are really going to focus on. So with neighborhood homes, timing of the credit is when you sell the home. So really you have the equity coming in, A little bit's probably going to be during construction, but I think a lot of that equity is probably going to be around kind of that completion of the home, and then you generate the credit. And so really the investor is going to have their equity into the project and get the credit very, very quickly. And I like math. So when you kind of look at the math of kind of how this is going to work, when you put your equity in and you get a credit right away, that's a very good return on investment. So I think on paper, I think credit pricing should be pretty good. But we also kind of know what's on paper may not really be the market. But I kind of think early indications are, it's probably going to be like the old historic credit, right? Old historic credit, equity comes in, historic credits at place and service, and you have a pretty good return on investment. So we're really looking at kind of historic credits, solar credits, how those functions, and really the timing of those. I think with solar and historic, the old historic, really plays well with kind of neighborhood homes. With anything, I think we're going to need treasury regulations, and we're going to need qualified allocation plans. So to get these, once it passes, I think to get it really off the ground, I think input from industry participants on really how this could be done quickly is going to come in the form of talking to your state, looking at the QAP, how the QAP can be structured to really deploy these funds. The recapture risk is minimal. So once the credit is earned, I think the investor has really minimal recapture. Actually, no recapture. So all the recapture kind of stays with the buyer. So really, you have no recapture risk, immediate credit close to when you put the equity in the deal. All that combined, I think it should be a pretty strong market, for our institutional investors that are out there.
Great, thanks. And I think as we look toward, enactment and implementation, and another good piece of news is that, like Deb, that there are also other HFAs that have been experimenting with different tax credits. Of course, we have now a lot of experience with the new markets tax credit being used for homeownership, and so there's a lot of lessons learned that we can build on. Thank you, everybody. Thanks, Kevin, Alex, Deb, Dirk, for joining us. Sarah, back to you.
Yes, great. We're going to quickly turn over to Brian, who's a partner at Porterfield, Fettig, and Sears and works closely with us on advancing our legislative strategy for neighborhood homes. And Brian's going to give us a quick overview of advocacy and next steps.
Thank you, Sarah. Are you guys there? Yep. All right. So now that we're all super jazzed about the bill, you're probably asking, how do we get this darn thing passed? We made a lot of progress to date by continuing to kind of advocate for tweaks to the bill to bring on additional support. The co-sponsorships continue, and we've had encouraging conversations with policymakers across the political spectrum, and we'll get into some of that in just a minute. The answer on kind of how do we get this thing passed, the coalition's agnostic, right, on the vehicle that it's attached to. It could be a bipartisan tax bill, could be a partisan tax bill like reconciliation, could be attached to a housing regulatory reform bill, it could be attached to a bill that has nothing to do with housing. But we're trying for everything, and I think what gives us a better chance is when policymakers hear from you all, and also when we add additional co-sponsors, and then a few additional tweaks are made to, again, bring on more support. So these are some of the tweaks that the bill sponsors have been thinking about to kind of improve it, or enhancements. So I'll just fly through these. Lowering the cost of the legislation. So the bill as introduced is a permanent tax credit. That would be ideal, obviously, but similar to other popular tax credits like LIHTC, opportunity zones, new markets, they all started as temporary, right? And so by not making it permanent out of the gate, that has the benefit of lowering the overall costs. And as we know, those previous tax credits that I mentioned ultimately became permanent. So the sponsors believe if we can move to like a 4-year program that gets the plane off the ground and can start showing real progress on the benefits of the program. The sponsors have also talked about increasing kind of benefits to the smaller and rural states. Again, that doesn't add much cost at all. It's just raising the minimum threshold. As you all know, the credit is allocated per capita, but for kind of there is a minimum, a floor that's raised from 12 million to 21 million for a few of the smaller, more rural states. Greater geographic flexibility. So we've heard from that. We've heard from outside stakeholders and just certain senators and HFAs that just want a little more flexibility. And so the base text, as Matt highlighted earlier on, it is targeted primarily to distressed communities. 60% and then 40% has a little more flexibility from the HFAs. The enhancement would essentially just say 60-40 for the larger states and then 50-50 for the smaller states. Right now, there is a little bit of restrictions on the 40% for the larger states, and this just makes it cleaner and simpler and just says, again, that flexibility. And that flexibility is important, right? From federal support, state support, local support. Okay, so better addressing the affordability gap, just some changes there to clarify some language. Same with the affordability gap. IRS probably would have viewed this anyways, but revised language could clarify that investors are entitled to a basis reduction for the portions of their investment that covers the affordability gap if there is a loss, and smaller builders and remodelers. So the goal, there's already in the base text kind of provisions that require the HFAs to minimize application burdens for smaller builders and remodelers. There's also a current set aside for 10% set aside for nonprofits. This enhancement would raise that to a 15% set aside for nonprofits and for smaller builders. And we can go ahead and move to the next slide. Okay, so these are the senators on the Senate Finance Committee. The ones in bold are our lead sponsors. So you heard from Senator Young earlier. Senator Warner has been a passionate advocate of the bill, as has Wyden and Tim Scott. We would love to add to kind of the co-sponsorship overall, but really we do try to target those on the tax writing committee because that's where this bill is referred to. And so I'm just going to highlight a couple of names for any of you all that do have relationships with these offices. And we are primarily trying to target Republicans. There's a little bit of a wait list on the Democratic side of the aisle, both in the House and the Senate. So a lot of this is focused on Republicans right now. But Senator Cassidy, Senator Daines, Senator Tillis, Senator Blackburn are all, I think, senators that we've had positive conversations with, but just haven't gotten over the ultimate hump of co-sponsorship. Senator Marshall co-sponsored last year or last Congress. We'd love to get him back on. I'll jump over to the House now. So in the House, we've got a few more co-sponsors on the tax writing committee. All the ones in bold, again, have been strong advocates to date. I'll highlight maybe just a few more here for those of you who do have ties. Congressman Fitzpatrick, Congressman Estes, Congressman Blake Moore, Max Miller. Those are just a few other names on the Republican side of the aisle. There are about 10 to 15 Democrats, as I mentioned, in a wait list on the House side. So there's a couple of these House Democrats who have already indicated they're interested, but we have been trying to keep it somewhat balanced just because it's had such strong bipartisan bicameral support. We don't want it to get unbalanced. And then these are some targets. This is kind of what we call low-hanging fruit. These members have co-sponsored. They co-sponsored last Congress. We'd love to get them all back on the bill. So any of you all that work with these offices, again, appreciate your help there. And that was rapid fire. So happy to answer any questions, turn it back to Sarah, and again, can talk about kind of prospects or anything else that you all may want to know.
Thanks so much, Brian. And folks can again drop questions in the Q&A box, and we will be sharing out these slides and I believe posting a recording as well. Brian, I do have a follow-up question for you. This is such a bipartisan priority, and I'll add on lines with stated priorities of the administration. What will it take for Congress to get this done? what's the next possible vehicle to get it across the finish line?
Yeah, great question. So as we know, the big tax bill last year, which did expand the low-income housing tax credit, anytime they do reconciliation, that's always encouraging vehicle to get tax-related items on there. Congress is talking about at least potentially two reconciliation bills this year. One they're actually already starting to work on that may just be more limited to DHS funding, but there could be something later in the year that would be a potential good vehicle for neighborhood homes. And there's also been talk about if that doesn't come together at the end of the year, there's always talk about kind of tax extensions or tax extenders, they've called them, and there could be some bipartisan interest there in a bipartisan tax extenders package.
Great. And another question, there are different proposals already out there, and we know more coming that want to get at the need for more starter homes. What sets Neighborhood Homes Investment Act apart? And I'll just take a first stab at this and then welcome my co-chairs and Brian also jump in. I think that we need a range of solutions. We need all the tools in the toolbox. There is not a singular fix, but neighborhood homes is going to be a really important part of that. It is the most, advanced in terms of being well versed on the Hill and popular bipartisan proposal that uses a tax credit structure. And we all know on the Hill there's different opportunities and appetite for things that require, appropriations versus can move in a tax bill. But it is the most popular bipartisan proposal that is exclusively focused on affordable homeownership supply. I also think it's really interesting that it's really focused on owner occupancy, which is timely in a lot of the recent conversations about institutional investors taking single family homes off the market. But I'll see if Brian or others want to jump in on what sets neighborhood homes apart.
I would agree with that. I think just given the broad support from a co-sponsor standpoint, also the outsider stakeholder support, I think is very impressive. If you look at some of those other bills out there, just doesn't quite have the large stakeholder support that exists for this bill. And so I think it is probably the leading candidate on the single family home ownership side.
Right. And then I have a slightly more technical question here. Could the neighborhood homes tax credit potentially be utilized if for rehabbing a home where zoning reforms like accessory commercial units or adding an ADU are allowed? Sarah, you want to take that one?
Yeah, it should be. It should be a permissible use. We have been actually working on some clarification, so it's crystal clear. But yes, the in areas where ADUs are allowable, especially for multi-generational families, and making sure that there's room for everybody, that should be a permissible use.
Right.
Yeah, I would emphasize, Sarah, to your point too, that the list of changes that Brian had kind of gone over that our legislative sponsors have agreed to include does include some technical things that were just too detailed for that list. And one of them, to Sarah's point, is this issue about ADUs. We just make sure that is covered. So that absolutely will be in the next iteration of the legislation we see. Also, manufactured homes. We wanted to put some belts and suspenders to make sure there was that all would qualify. So you'll see these kind of technical amendments as well.
Right. And then there were a few questions about the legislative strategy. And again, I would say if you have a really strong relationship with a congressional office where you live or work or operate, and you think there'd be a lot of interest in having a leadership role or co-sponsoring this bill, just don't hesitate to reach out to us and we can connect with you on whether they're an existing co-sponsor or not, or there could be potential opportunities for them to really help champion this legislation. Very much the more the merrier. And you can send additional questions to neighborhoodhomes@nal.org. So with that, yep. And again, we will send out all of this content. We are just blown away by the attendance here. We're going to keep engaging folks. Also, national organizations, if they're interested in joining the coalition, can reach out to us. We do various Hill days and a lot more to come. So with that, I want to thank all of our panelists and everyone who is part of the Neighborhood Homes Coalition. And you know where to find us if you have questions. So thank you, everyone.
Thank you.
Thank you.